people together to talk about risks from last year, dumb ideas, and how to avoid them. We've got Gina Martin-Adams, who is not only the global head of portfolio strategy, but also the chief equity strategist at Bloomberg Intelligence. So basically like the person that knows the most about equities on the planet, here with us today. And we've got Dr. Daniel Crosby, psychologist, behavioral finance expert, and New York Times best-selling author with a new book coming out this year, right?
October.
Soul of Wealth. You can pre-order it on your buying platform of choice, which of course is Amazon for most people.
Amazon.
And last but not least, Phil Toews, who uncoincidentally, today is his birthday. And he has been in the risk management business his entire professional career. So this seems like a joke because we made up a holiday. And oh, by the way, look at our fancy merch. Got our NIRD merch, National Investment Risk Day, for all you acronym lovers out there. NIRD. It seems like a joke, but it's actually really serious. So Phil, tell us how you came up with that, and I'll take off my hat because I look ridiculous.
Yeah, so a former staffer actually came up with the idea, Dan Coleman. But here's what we're doing. Like, so if you think about like the trajectory we've been the last 25 years, like let's look at the internet bubble as a starting point. And some of you on the line may not know what that is, but the internet bubble was a time when people started investing in companies that had no revenue or even prospects for revenue. I remember hearing people talking about just putting together a PowerPoint and going to get tens of millions of dollars. And what was so surprising though about that instance is that it wasn't just like crazies on the periphery doing that. Some of the biggest institutions in the world came on board and started supporting it, covering it, investing in it. And then just, 8 years later, with the financial crisis, you have mortgages that are basically worthless, supported by people that are unable to pay them, packaged together in AAA things. Once again, some of the biggest banks and organizations and asset managers in the world supporting it. And, so one of the things that's so amazing to me is not that it exists, because Ponzi schemes, all kinds of things exist, but that each time, each iteration, we have situations where there are things that don't make any sense at all, but merely because they've gone up in value, so much, everyone comes on board. And so the point of this day is to have one day where we just sort of call out, say like, what is going on right now? Is there anything that people are doing, that we're doing, that institutions are doing that makes no sense, that a year or two from now is going to look like sheer folly? So that's what we're doing.
All right, awesome. So we've asked Gina and Daniel and Phil to come up with their 3 worst investment concepts from last year. So not necessarily a ticker, but an investment concept. And so we've got Gina's institutional perspective. Daniel is the foremost authority on behavioral finance. We've got Phil from the investment manager perspective, and I'm just along for the fun. So we're going to go around and just list them and debate them and have a good time with them. Gina, do you want to get going with yours?
Oh, sure. I think that probably the biggest mistake that institutional investors made in 2023 was really using economic forecasts to design their equity market strategy. I mean, generally, economists, of course, coming into 2023 were quite bearish on the overall outlook. For whatever reason, the psychology of trying to predict a recession and just kicking the recession prediction can down the road quarter after quarter after quarter appears to me to be dominating institutional equity investor psychology. And we've moved back in 2021. If you think about where we were in 2021, we were in excessive risk-taking mode in equities. Everybody was buying every SPAC that came to market. The meme trades were dominating all aspects of equities. That environment really died by the second half of 2021. And 2022 really started to become this era of fear once again. And that persisted into 2023, despite the fact that there was really strong evidence by the end of 2022 that we should be moving in a different direction. So I'll just sort of generically say, letting an economic forecast, sort of the psychology of fear really dominating an investment strategy, it resulted in a lot of institutional underperformance in equities last year. That what started as fear about the broader economy became a lot of explanations that, well, the equity market's only rising because the top 7 stocks are rising, and therefore it also is a falsehood. All of these things have proven to be really terrible in terms of investment advice. But yet, I think that there is this environment of fear perpetuated by economic forecasts. And frankly, stocks and the economy are not the same thing. It's something we talk about a lot is earnings drive stocks. The economy doesn't. Earnings in the economy are definitely not the same thing. And so doing your homework within the equity market to really think about what's happening on earnings, really analyze what's going on beyond what economists tell you is or is not likely to happen in the year ahead proved to be the most efficacious strategy for equity investment. And in the end, 19 of the 20 largest markets in the world posted very strong gains. It was one of the 6th strongest equity markets in the last 25 years in 2023. It wasn't just about the top 7 stocks, despite popular rhetoric. Even small caps posted a near 20% return last year, and that's been the big laggard. So, I think that just generally thinking about formulating an investment strategy on rational principles as opposed to fear and forecast is something that I would like to highlight.
Awesome. On your forecast, we've been tracking since 2000 the top Wall Street's predictions for what the S&P will do that year and then how wrong they are.
Yeah.
And they've only nailed it once, and that was in 2005, which I would call that an accident. But the last couple of years have been particularly bad. So in 2023, the average forecast was off by 28%. In 2022, it was off by 27%. In 2021, it was off by 18%. I mean, this is wildly wrong. It's not even just inaccurate. It's just nonsense when you're that wrong.
And the average is up by 13, right? If you look over the last 20 something.
Since 2000, the average is 14.
Okay.
Off by 14%. Right. Daniel, you're up.
So I'm going to continue in this vein. My second one, I'm going to share it now because it's so similar to Gina's. It was taking seriously the unserious business of forecasting. So to sort of continue with some of what you were saying, I looked at 23 estimates from white shoe Wall Street firms. 22 of them were below the realized result for the S&P. Again, like you said, the average miss was well better than 20%. The dispersion in the ranges of those estimates was 1,400 points, right? 1,400 point dispersion in these estimates. And if you go back to the path-breaking work that David Dreaman did on sort of contrarian investment strategies, he looked at this over many, many decades, tens of thousands of estimates, and found that Wall Street analysts were right about an estimate one time in 170. So it is a massively unserious thing that we dignify in ways that we shouldn't. And so sort of as the psych guy, I'll maybe speak for a second about why we continue to do this. If you look at the brain, right, we have brains that account for 2 to 3% of our mass, our body weight, but that consume somewhere on the order of 20 to 25% of the calories that we burn in a given day. So we are always looking for ways to think less or to sort of coast off of someone else's thinking or decision-making prowess. And I think investors do themselves a great deal of harm when they offload the rational thinking process that Gina is talking about and hand that over to a Wall Street forecaster. So when you look at fMRI studies, brain scans of people who are watching a financial forecast, the part of their brain associated with critical thinking and decision making quite literally goes dormant, goes to sleep. So it gives us a sense of cognitive ease but it is quite literally false security, as we can tell from what Gina talked about, what you talked about, and what I've just shared. It's a whole lot of danger. We pay a very steep price for a little bit of cognitive ease.
Thanks. Do you know, for Gina and Daniel, obviously in your world, Gina, the forecasts, that's an important thing that people do. Is it that is what it is at that moment, and looking at it tomorrow is something different, and looking at the next day is something else, and it's sort of an ongoing rolling thing that's just an important tracking of what's happening? And for the average investor, it's who's got a time frame of 30 years rather than 30 minutes or 3 days. Is that part of the irrelevance there?
I think that the really significant part of the irrelevance is really just our misuse of forecasts, because I actually find, for instance, consensus bottom-up estimates really useful in certain instances. We can use them for analyzing trend shifts in general terms. We can use them for them as well as macroeconomic forecasts for imputing what's priced into equities, given those forecasts. And we can look at sort of how they have shifted materially in the future, in the past, and what that has meant for equity movements. But I think when we sort of unfortunately misuse them as gospel and then misapply them, in the case of the economic forecast, it's just simply misapplied as a driver of equities very consistently. That to me is the real danger. There is a lot of value in these numbers, but you have to use them appropriately. And so we use the numbers in our modeling capability for what do they mean for stocks. As they move, they typically are very meaningful for performance momentum shifts in the equity market, for example. But just sort of blindly suggesting, hey, sounds like we're headed into recession, therefore I've got to get out of all equities. That's the type of reaction that we seem to be implementing in our portfolios that is just entirely inappropriate. That's the way that I would sort of characterize it.
Great. Phil?
Okay, I'm going to lead crazy investment ideas with the NFT, the Merge. The Merge is an NFT that initially sold in the end of, I believe it was 2022 and it brought in a total of $92 million. What's unique about the Merge is that, you've heard about big sales price tags for NFTs in the past, but the Merge was actually, you could buy units of it. So in the end, there were over 300,000 units of the Merge sold. And, around 20,000 different people were participating in this. And initially it ended up being as high as $750 per unit. Well, since that initial sale, it's estimated now it's down about 96% off of that one price. But in 2023, the price declined by 55%. And so it's one of those things where this is not my top vote, but among the top. So it gets worse than that, but it's just like, I made this statement and annoyed Eben because he's so annoyed when I bring up tulip bulbs because everyone's so tired of it and it's a cliche. But one thought I have around the tulip bulb phenomenon is that at least it was a thing, right? At least it was a bulb, right? But with NFTs and around the NFTs, like I wanted to get a friend of mine is a digital artist, a guy named Phil Toledano, and he's does fantastic work. Search him up on Mr. Toledano on Instagram. And I said, I wanted to call him and say, help me understand the real value of NFTs from a real artist who sells them. His first thing was I don't understand it at all. Why would anyone invest in something that just lives on your computer and not be on a wall? So that was my attempt to get help me understand the real value in NFT from an artist perspective, but I couldn't do it. So that's my vote for one of mine.
All right. So one of mine, and this is kind of holds true forever, which is individual investors LARPing as traders. And most people are not traders. That's not their job. But, most people should be, or at least, they should be long-term investors, right? That's what most people should be. But the sort of ZERP world followed by stimulus, pandemic, Robinhood existence elevated all these people to thinking that they are excellent traders because they happen to be investing at a time when the market's just been going nuts, right? And if you're not familiar with the term LARPing, it stands for live action role play, and it's grown-ups who dress up in maybe ye olde gear and speak in these and thous and hit each other with foam swords. So individuals LARPing as traders, don't do it. Stick with the foam swords. All right, Gina.
Okay, you want another one? I'm going to go with dumping into Chinese equities and getting irrationally exuberant about the prospects for growth recovery in China as one of the worst investment calls of 2023 as well. And I think that this actually stems from really a geographic there's a geographic component to this or a cultural component to this, because from my observation, most Asian investors actually were not terribly optimistic about China's growth going into 2023. But basically the entire continents of the US and Europe were very optimistic. And so from an institutional investor standpoint, I think this stems from the idea that the US and European investors' experience in the post-pandemic recovery in the US and Europe was immediate growth, very, very strong growth, as a lot of that pent-up demand during the pandemic ended up resulting in very strong demand growth and really vicious gains in the equity market when we all came back to work. We assumed that the same reaction function would happen in China, and it did not. And I think this was fascinating because we all made this assumption based upon our experience without really analyzing and understanding the experience of China, which was really a doubled pandemic shutdown. So there was naturally significantly more reticence on the part of the Chinese consumer, the part of Chinese businesses to recover rapidly. They may have had some pent-up demand, but they weren't really willing to part with their cash under the idea that perhaps they have a third lockdown coming within the next 6 months. They had been through a very, very different pandemic sort of experience than we did in the Western world, and we just assumed that our experience was going to be replicated in China. And I think the result was really horrible performance in the Chinese equity market, quite contrary to what everybody was expecting. But a lesson to be learned in kind of geographic bias. You got to do your homework. You need to understand what the local market, the conditions that the local market faces. What happens in the US is not the same as what happens in Latin America, what happens in Asia. And we've got to do a little bit more work rather than sort of painting everyone with one big similar brush, if you will.
Gina, does sort of like the downturn and maybe more favorable valuations create any optimism for you? And I know we just all thrashed making projections, right?
Yeah.
But
I would love to say yes. Our fair value models for China actually do show that there is a decent amount of value there in China. But at the same time, our quant strategist just came out with a note last week, which I'll feature on social media early next week. And he did some simulation analysis and just based on China's equity markets historical experience, there still is a considerable amount of potential downside risk. So you have to, we all want to call this reversion to the mean trade. I definitely would love to. It looks incredibly cheap. I'd love to say that valuations are oversold and you could get a bit of a bounce in China, but it's, risk reward. Is something to very much consider. And historically, the Chinese equity market goes through these periods of intense underperformance that can last a lot longer than any of us want to believe. So I would just caution investors, do your homework. If you've got a long-term time horizon ahead of you, then the valuations look incredibly inexpensive, but don't count on reversion to the mean just based on a valuation abnormality.
Thanks. Daniel?
Yeah, so my next one is a bit like Phil's. We'll call it pseudo scarcity around NFTs. In particular, the story that struck me was a very exclusive party that only holders of one specific NFT could gain entrance to. Once inside, there was a dance party, lights, food, drink, whatever. Well, the lights that they were using at this dance party were the UV lights for sanitizing surfaces. And so people who went to the party got photokeratitis, which is like welder's eye, the same sort of thing that would happen to your eye if you were welding without a welding mask. And so tens of people who were at this party were rushed to the hospital. They're posting multi-$1,000 ER bills and reports of being blind at 4 a.m. in the morning. Everyone seems to be doing okay now, which is why I feel okay laughing about it. But again, there's sort of this pseudo scarcity around really kind of corny and dorky, prizes on the other end of that, not much underlying it. And I think sort of ignoring some of the real power and potential that exists in the blockchain for artists to do things like, gauge the provenance of a piece of art or something like that. I think there's real utility to be had there. And I think it's getting lost under this sort of corny facade of exclusivity.
Yeah.
I mean, pretty rare that you have an investment strategy or an investment that actually causes physical harm. I gotta say, Daniel, that's pretty profound.
In that case, Daniel, I think you win.
Yeah, I don't think we can top that.
You may lose some money. It's not often you lose money and go blind.
Yeah, it's extreme. This is now extreme sports.
Daniel, the name of that NFT for future partygoers?
It was Bored Ape Yacht Club, one of the big ones.
Yeah.
Okay.
Bill.
Yeah. So my number 2 is an ETF that ended up closing in 2023 with the ticker MEME, MEME. I actually find ETF marketing fascinating right now because I think if you just get the ticker right, you're there because everyone understands exactly what it is. And that's a great name for this ETF. Well, it never really attracted much in assets, but I just have to say that I chose it because it's another example of where you look at something and it's like, well, that just seems like a super bad idea to price up a stock that's worth nothing to like many billions of dollars in value. And of course, on average, the smaller investors that come into that are going to lose a ton of money. So it's a perfect example of why we created NIRD Day. But along with that, another thing that makes it like among the dumbest of the ideas is that it rebalances every 2 weeks to an equal weight. So if the whole idea is that you come into a crazy stock and then it grows to a huge amount, that's not even going to happen inside of this ETF because you're going to keep rebalancing it out and you're never going to get that huge momentum in one stock. So MEME is number 2 for me.
It's interesting, like, as you said, everybody knew about that ETF. Like everybody knew about it, but interesting that it didn't attract much assets, just a lot of attention. So I'm gonna bounce back to the NFT world and talk about Fly Fish Club, which is a restaurant/club, embarrassingly in my neighborhood in New York City, that can only be accessed through ownership of an NFT that theoretically you can sell it, you can transfer it, you can even lease it to someone who's also sad. But now let's think about, all right, so you're buying a membership to this club, which is an NFT that theoretically can increase in value. And the original mint price of these, there were 2 levels, was between $6,000 and $10,000. Now those 2 tiers range wildly between $15,000 and $425,000 for the same thing. It's the same amount of access to this place, but you can pay $15,000 or $425,000. Why would you pay? Well, first, why would you pay the $15,000? Who insanely would pay more than the lowest amount? And then secondly, the idea of like ownership as investment, or rather membership as investment, is crazy. And now let's think about New York City and what there are tons and tons and tons of in New York City. Excellent restaurants. And let's think of what in the first year, 60% of restaurants fail. Within the first 5 years, 80% of them fail. So it's an incredibly difficult business that you're limiting to a group of NFT enthusiasts who, I mean, I can't imagine it's more than like 9 people now, right? Nobody cares about NFTs anymore. But that's one of mine. Like, I actually applaud them for trying to find something new to do with NFTs. I think that's interesting. I think we're going to find a space where they exist and they're useful and they will have utility. Like over the top restaurants in New York City, I don't think that's it. Just yuck. Gina?
I like that one. I want to comment on something that Philip brought up with memes, because this is something that really bothers me. So I'm just going to share a little bit. Might be a bit of an overshare. But I do find that the vast majority of the ETF industry is really structured around selling a product, obviously, and the naming and the tickerizing of the product is a huge part of that industry. And it's always been a big frustration of mine that we spend so much time as an industry not vetting out a strategy as a great idea as a strategy, but really just vetting out a strategy that probably sells. And I think it's important to acknowledge in the investor base that among investors, we really should be doing a homework on finding a strategy that works, not finding the sexiest name that sounds really good when you're implementing these strategies in your portfolio, because I do find it very frustrating because, benchmark providers and ETF providers do spend a lot of their time sitting around thinking, ooh, right now, for instance, inflation protection was a really big theme in 2022, but structuring the right inflation protection was maybe not as much a part of the conversation, right? It was, ooh, we've got to get an inflation hedged ETF out to market because everybody wants to buy that right now. Is it really an inflation hedged ETF or is it just a named one? And I think we need, as investors, to do that kind of homework. But just to get off my soapbox for a minute, another idea on things that really didn't work in 2023, I think, sector strategy comes to mind. That sounds super boring, but really coming out of 2022, when energy stocks outperformed tech stocks by 90 percentage points just in the S&P 500, I think the investor base was overly anchored on a persistence of that trend. So we saw, energy outperformed so well. Everybody was basically overweight energy and underweight tech coming into 2023. And then those sectors flipped in 2023. Energy underperformed tech by 60 percentage points over the course of 2023. And in my work, most investors really missed that flip. And they missed it in part because they were overly anchored on their most recent performance. They, looked at energy as a persistent performer in 2022. So of course it would continue. They were also, I think, overly influenced on the idea of inflation getting embedded and not as nimble as they could have been. As the data changed, it was really clear in January of 2023 that something was shifting in inflationary conditions that was going to work to the detriment of inflation hedges. But people were really, really slow to adopt that because they were sort of mentally stuck on this idea that inflation is getting deeply embedded. You've got to have inflation hedges in your portfolio. And so therefore they stayed in energy far too long, and also really didn't adopt the tech trade, even though all of the evidence in earnings was pointing to a really quick recovery. You even had non-AI types of investments in tech start to improve materially because companies were cutting costs. There was a lot of pushback on the tech trade for at least the first half of 2023, even though there was some really sound fundamental evidence to suggest that tech would be a better performer. So I'll go with the sector sort of trade-offs of the last 2 years. It's been a really difficult climate to invest in, but being more data nimble and data centric could have helped investors quite a lot in navigating that transition in sector performance.
Thanks. Daniel?
So my last one is going to be confusing innovation with investability. So for me, 2023 was sort of the year where AI landed on all of our desktops in sort of a usable way. And I think even though we've been talking about it for many years, I think the speed with which ChatGPT and other platforms arrived in a usable way. I mean, I'm using AI now multiple times a week and soon to be every day. And I think that's true of many business people. And I think along with the rise of AI, you saw this enthusiasm for investing in AI. And, Phil kicked us off with talking about the .com bubble. And, we saw this during the .com bubble. There's all these great stories of there was a laxative company who, put .net in their name and people confused it with an internet company and it went through the roof, right? During the height of cryptomania, there was an iced tea company in New York that switched to being, blockchain, iced tea blockchain. Their stock price went through the roof. And, Warren Buffett has this great quote about if a far-sighted capitalist had been at Kitty Hawk, he would have shot Orville down because, investing in airlines has been such a mess. And we're seeing it again this year. The airlines are having trouble. So we tend to conflate the impact of something in our daily lives with its advisability or its profitability as an investment. So the internet has absolutely changed our lives, but most .com companies were a mess. Air travel has revolutionized the way we live our lives, but most airlines have not historically been a good investment. And I think that we're seeing that with AI. Like, I think AI is coming. I think it's going to be powerful. I think it's going to be every bit as transformative as has been advertised. But that is a different conversation than saying that any AI themed equity is going to be a good investment. And I think that's something people have a hard time getting their head around.
Yeah, that's great. Totally agree. Phil?
Okay. Well, Daniel expressed a concern that it would just be a crypto bashing affair, and I'm going to help make that a reality. Okay. So, the thing I'll say, about Gina, the equities you're talking about, Daniel, even AI stocks, internet bubble stocks, even meme stocks, is that at least in the world of equities, you have the plausible story that these things one day will earn a lot of money, be worth a lot of money, and therefore the sort of like very early investment into this is a great idea. I think that the thing that is, to me, is just amazing to watch is the world of cryptocurrencies, and I'm thankful, at least for this webcast, that Bitcoin ETFs were approved a week ago. So we got up to a total valuation in cryptocurrencies of around $3 trillion prior to the bust that we experienced in the last couple of years. And I was at the time writing that, if you can get up to the GDP of France in terms of the total valuation of cryptocurrencies, does that start to create systemic risks? And I think we can argue that it did. There were some mini systemic risks that we saw as a result of some of the implosions of these different trading platforms for cryptocurrencies. But I think what we face right now is, okay, I'm just going to give this about cryptocurrencies. I think it's the trifecta of bad ideas. But for number one, there is no income or potential income and no assets. It has appreciated 18 million % in the last 20 years, but it has this word currency in it. And I think that word currency adds to the credibility of it. And you've got all these layers of credibility coming in. A couple of years ago, you saw some big institutions invest $500 million into sort of the infrastructure. But this last step, which is creating a viable path for the average investor, for the average wealth manager, so that if it continues to appreciate as it has done this year, and it goes higher and higher and higher, and if, let's say, God forbid, we do get up to $100,000, $200,000 on Bitcoin, just based on my experience of watching advisors and investors in this space, everyone's going to then feel it's an obligatory percent in an asset class or in a portfolio just because it's gone up. So that the trifecta of bad is that it's got all of these. Last fool in is the biggest investor, or the last investor is the biggest fool, because there's a greater fool out there and you can buy. It's a purely speculative phenomenon. If it is a currency, if that's what it is, what has the dollar done over the last 90 years? It's lost about 1.5% in its how much you can purchase a year. So currency doesn't mean you're going to get rich doing it. Currency just means you can trade it for other things, for goods and services. So this phenomenon is entirely based on the gain that we've seen over the last 20 years. And I just don't know what the total market cap of cryptocurrencies can be now that we've created this pathway for the average investor. So I know they didn't launch in 2023. Eben was calling me out and saying it's not a 2023 thing, but they were filed in 2023, so I'm running with that one.
I call cheating, but Gina, you've mentioned before the institutional bleed from the the retail investor into the institution. Into the institutions? Do you have examples of how that crypto has bled into that world, or examples rather of ways in which the retail investor has bled into the institutional world and gone wrong in the past?
I think probably the best example of it is actually your example of retail investors that think that they're professional traders. I think that's the single best example of, a retail investor bleeding into what is an institutional realm. And a really good example of how that went very bad is in meme trading, where when the meme stock trading took over in early 2021, the retail sort of trading universe really attempted to overwhelm what were hedge fund shorts effectively. And what we ended up finding out was most of those retail investors ended up very, very damaged financially, and the hedge funds suffered no consequence. So I'd say that's the best example of it. I think that retail investors often get sucked into a lot of products, and that happens all over the ETF universe. We've had a couple of good examples of that today. Even all the way back in right before the 2006-2007 crisis, one of the greatest red flags is when retail investors start asking me about securitized products. There's another great example. Obviously, that didn't work for anybody, institutions or retail investors. But I think there are a lot of these kind of examples smattered throughout financial market history.
Yeah, if we are to believe Cathie Wood's projection that by 2030, Bitcoin will be at 1.5 million per coin, that's a roughly 76% annualized return, which I just did in my head magically. Phil, is there any percent allocation in a portfolio that makes sense to you?
I mean, I would just think of it just like gambling. So to the extent that you want to spend your money on gambling, understanding going in that the probabilities are that you're going to lose some or all of your money is that percent. But I just think it's inevitable with these ETFs that it's going to be greater. The thing that I didn't state explicitly is that I think the thing that we need to watch out for is that there will be, if we get to a 10 trillion or a 20 trillion or a 30 trillion total capitalization of cryptocurrencies, it's very clear at that point once you approach the GDP of the United States in terms of total valuation. And I think it's not off the table, but I think it's something that could create massive systemic risks down the road that we all need to think about. And my answer is no. Like if it doesn't have a reliable source of long-term gains, then it shouldn't be contemplated in a portfolio.
Okay. I'm going to take your trillions down to billions and talk about my last one, which is sneakers. The sneaker trade in terms of resale, trading sneakers as investments is a multi-billion-dollar industry. And basically, if you look from any city from Budapest to Boise, every storefront practically that was vacated during the pandemic has popped up as a high-end sneaker trading establishment. It's bananas. And I live in downtown New York City, where it seems like there's weed shops and sneaker shops. That's all that's there. And sneakers are not investments, folks. It might be fun. They might go up in value, but they're not actual investments. And they start to break down after 12 months. In 15 years, they're worthless. And I know there are certain, like your Michael Jordan game shoes from whatever that are $2 million. Like that's a different thing. But your average individual who's buying and selling sneakers and thinking of them as investments, nope. Sorry, Daniel.
This is so interesting to me, even because I had a quick personal story. We lived in an apartment building in Jersey City, New Jersey, which for those of you who are not Manhattanites, right outside of Manhattan. And in our apartment building was a young man who within the next couple of years became an NBA basketball player. He was playing basketball in, the lower divisions or whatever it is, the farm leagues that lead to the NBA. And he had an entire room in his apartment dedicated to his sneaker collection. But his approach to this was not to wear the sneakers. It was to buy the sneakers and store them. And he was way ahead of his time because this was 2005. And I wondered when I saw your submission of your idea, I wondered what his sneaker collection is worth today, because he approached it like some women approach Hermes handbags, right? It's an investment and it's not to be touched. It sits on my screen, or like some people approach baseball cards. And from that perspective, I think, frankly, his investment probably has done very well. Because he did have a bunch of original Jordans and he didn't wear them. So he didn't wear them out. Now it's dependent upon this maintaining its popularity. But I think he would prove your theory that sneakers are not investments wrong so far.
You're right.
So just food for thought. It's more than sneakers, though. It's interesting because these consumer products, certain segments of the consumer products industry are viewed as investments by segments of the population. It's obviously very risky, and you're dependent upon a larger segment of the population ultimately getting on board with you over time. But it's fascinating. They certainly aren't going to pay you dividends or pay you back like a stock would. Not that I'm selling my book here or anything, but it's a fascinating concept to me.
Yeah, and gold doesn't decay in the way a sneaker does. But yep, interesting. Yeah, that guy probably is doing all right in more than one.
He was an NBA player, so he's doing all right anyway. But his investment strategy really reflected his expertise, which I respect. This is something he knew a lot about. His investment strategy was to buy and store shoes that he would never touch. I don't know if he ever sold them, but it's just worth noting.
Indeed.
As a baseball card collector and a sneakerhead, I feel extremely targeted by this conversation. I'll be leaving now. No, I think one of the things that we saw during COVID, and I mean, this played out exactly this way during COVID for me and my son, who got back into the hobby, as we call it, of baseball card collecting, is that everyone had all this time, everyone had all this stimulus money. And I think there was a real warmth and comfort around nostalgia and sort of a reflecting on what now seems like a kinder, gentler, simpler time than 2020. And so I think people, who now have disposable income are looking back at the Jordans that they couldn't afford when they were kids, or the baseball cards they wanted to collect. And I think there was this enormous rise in the collectibles market during COVID and in the months and years that followed. I think that's always going to be there to some respect, but I think that was artificially inflated by the particularities of COVID and just sort of what a psychological need nostalgia met at a scary time for a lot of people.
That's really, yeah, thanks for bringing it there, Daniel. It's interesting. So this has been totally fascinating. I can't thank you all enough.
Eben, Gina had a fourth.
Gina has a fourth.
Oh, we could go into my fourth if we have time. I'm happy to.
What? You want to?
My fourth is actually Japan. And the fact that investors missed the upwave in Japan. And this is again about kind of anchoring on past performance as predictive of future results. I think basically the entire investment world gave up on Japan ever contributing anything to equities. By the end of last year, nobody wanted to touch it. I don't know anybody who was saying you got to go all in on Japan in 2023. And yet it was one of the best performing equity markets in the world. And we're now sitting here contemplating a pretty big sea change in Japanese central bank policy. The economy has really turned things around, and it happened sort of in a post-pandemic on a dime kind of experience that no one anticipated. So long story short, kind of writing economies and markets off because they've underperformed for an incredibly long period of time. Probably not the right strategy. And that was very evident in Japan. So.
Thanks. So Phil, do you want to put up the poll? And I just want to.
Oh yeah.
So we're gonna ask our audience to vote on their top three worst investment ideas from last year, and I'll ask our panelists, what can you leave us with? Just a short sentence on. Well, it doesn't have to be a short sentence, but a short thought on how we can avoid these traps going forward. Daniel, go for it.
I'm gonna give one that I think is topical for the year ahead, and I'll talk about politics. Recently came across some research that looked at 60,000 retail accounts over a series of decades, and they found that people whose non-preferred political party was in power underperformed by 2.7% per year. And there were a couple of reasons why they did this. They tended to divest from the U.S., right? So if your non-preferred party has the White House, they would say, well, things look bleak for the country, so I'm going to shy away from the U.S. They tended to hold more cash. Their portfolios had lower betas. And then most impactfully, they tried to time the market. They would jump in and out of their accounts because they were twitchy about the fact that their non-preferred candidate was in power. So it promises to be a horrifying election year. I think even unusually so, like unusually nasty, even among election years. And I know that people are going to decamp into right and left and start to make investment decisions accordingly. So sort of forecasting and all the folly that accompanies that, I think we could forecast that people are going to be in their feelings about who wins and who doesn't and make bad financial decisions as a result. So that's sort of something I'm watching for in the new year, is trying to divorce my politics from my investing.
Fantastic. Gina?
Sorry, I muted myself. I'll follow on with that because I completely sympathize with that. In addition to the financial implications, we're actually finding that political affiliation has direct results on even consumer sentiment surveys. So perceptions about the outlook for the economy are materially altered now by political affiliation and who's in power. And you see really big shifts right around election dates, which is a bit disturbing because many people use those sentiment indicators as inputs into their economic models, as inputs into their financial process. So I completely sympathize and agree with Dan's point. I would just maybe add on to that in that get out of your head and get into the data is something that I believe in very, very strongly. Do your absolute, if you are going to be a more tactical and nimble investor, if you're, not going to set a program and just let it ride. And if you do feel compelled to be more tactical, be tactical because the data tells you to be tactical, not because you're emotionally engaged in the process, because that emotional component is so disruptive. And I just think that's probably the best advice that I can give anyone.
That's Phil, I'm going to get to you in a second, but I want to follow up, Gina, with mine, which is if you're searching for the next big investment that's going to propel you into your future rich self, like there's some hole you're trying to fill, right? And the best way to fill that hole is spending time with people you love, not Googling what you think will be the next best investment. So spend time with those that you love, and that will pay much better dividends than whatever investment that you're going to try and chase. Phil?
Yes, I would just say two things. One I mentioned earlier, which is like, we've got a list of criteria for thinking about what to include in the portfolio. And the first is, what's the ultimate source of the returns of this investment? And is it a reliable long-term source of returns? Interesting thing about that is one thing that might exclude is an asset class that maybe has done well, but relies entirely on manager talent, right? A good example of that might be something like managed futures. It can be negatively correlated to the markets, but managed futures over the long term have a 0% return prior to fees. So that would be something I would ask the question. And if it's not a reliable source of long-term returns as this underlying core asset, the exposure there should be quite limited, I think, in terms of a percent. And then number two is just like thinking like a contrarian, right? So if everyone's thinking one way about something, and that would mean that maybe an asset has increased dramatically recently, do you want to be the right side of the contrarian trade? Now, granted, momentum can go on for years, right? So you can have momentum one year and it can go for 3 or 4 more years. But as a reason for coming into an asset or increasing your exposure to the asset, it's probably not a great idea to come into something that has moved up a lot recently. So you want to be on the right side of that contrarian trade. You want to be a contrarian, not just piling in.
Daniel, Gina, Phil, this was awesome. It was so much fun. Thank you very much for joining us, and thank you all for tuning in with us today. Have a great weekend. Take care. Bye-bye.